CPI.io. Music licensing reimagined. Artlist.io.
What's up, everyone? Welcome to the Daily Macro Update for Monday, December 22nd. I hope you enjoyed that copyright-free Christmas music that I just downloaded before the stream that I didn't know had the copyright ad-libs in there. But hey, you gotta love it, right? I'm currently in a Starbucks right now because my internet decided to go down at my office, and so the people are there working on it, so I had to run over here to do it a little early so I can go back. So hence the earlier stream here today. But I appreciate everyone for joining here. I know that we didn't do one on Sunday for the Sunday wrap up, as well as we didn't do one on Friday. So I know it's been a few days, but nevertheless, we are here to talk about that CPI report that we received last week. And there's some mixed feelings about it. But of course, on this channel, we know that we don't do feelings. We just take a look at the data. But, I did notice that there was a lot of people talking about how, this inflation report is a total sham. Inflation is much higher than they're reporting. And, the Fed is making a huge mistake right now. Whereas other people in the Fed, such as Governor Miran, went on a Q&A today and talked about how they're still going to lower rates because this latest CPI, even though it was an anomaly to show that there wasn't enough data to definitively show a drastic decline across the board in inflation, they still believe that inflation is going to continue going down and that they are going to continue to, cut rates from here. By the way, if you guys hear the background noise in the Starbucks, just let me know. But I have the little microphone here, so I think if you guys can't hear me, let me know. But if you can, just put a 1 in the chat. But anyway, so there was a huge debate on the inflation reports, and we can take a look at that from the actual BLS data. And as you can see, the October and November lines here, I think this is the household survey, both of which are incomplete by a large amount, right? And so this inflation print by itself wasn't too helpful. But we can still take a look at forward indicators to see what those are saying. And so I put out this tweet on, I think it was on Friday. Let me see. Yeah, this was on Friday here. Even though the CPI print, which again is backward looking, right? We just, as macro investors, we only look at CPI reports to confirm the data that we're already seeing in some of these leading indicators, 2 of which I have that my team and I likes to use. The red line there is the 5-year break evens, which I'm sure you've heard me talk about before. And then the blue line is the price of oil. And the rate of change of both of those, as you can see, have been decelerating since July of this year, which is showing that even though that we had that government shutdown data, you can see from the months of October and November, both of these numbers are declining at the same time. Which is kind of in line with what the Fed's expectations are with disinflation. And then also as well, you don't just have to take my word for it. You can just look at the yield curve here, which is, has been steepening, right? And when you have a bear steepening type of yield curve, that is more of like a recovery where it's mainly being driven mostly from growth, right? That is where the long end of the curve rises more than the short end of the curve. and we're actually getting the opposite effect, or they're going in opposite directions, right? So the longer duration yields are going up, shorter duration yields are going down because they're cutting interest rates into accelerating growth, and so that's why we're getting the steepened yield curve. And this is really pointing towards more of a soft landing type of probability than not. And that's why you see things like small caps, things like Tesla making new highs. Look at that. And so JP Morgan, Nvidia is trying to have a little bit of a bounce here, still remains in bearish trend, but yeah, Tesla, JPM. You still have really strong trends from things like Google, which could have another leg up here after consolidating for a little bit of a little period of time. But yeah, so you have about an hour left in the market, and the S&P 500 is on track to get close to closing at new highs, right? And that's why when we posted the other week on don't fall for a lot of the bearish narratives that are out there, this is what we mean, right? Now, this most recent move here, it is Christmas week, and so it's relatively low volume. It's a pretty short week in terms of data goes. It's kind of like Thanksgiving, where you have kind of those low volume moves that typically go in the trajectory which was already being formed, which is this little bit of a bounce here. And so when taking a look at the schedule for this week in terms of data, I mean, just take a look at this. We only have tomorrow as the only day really that's going to be producing any type of data, and the main ones are the GDP number, and then we also have the ADP weekly employment change. That's something that's new. Durable goods orders, and then we have the Richmond Fed manufacturing index, which that's not like a huge number or a huge amount of data dump. So it's a relatively quiet week in terms of macro data being released. So we could continue to see this little bit of a Santa bounce and things that we're having a little bit of a discount from last week, but still, the things that are going up the most and will continue to do so that we've been talking about that we are long are things like platinum. Look at this thing. Oh man, huge move on higher volume. That is a clear bullish sign for the macro as well. But we've been talking about it even during this consolidation period. If you go back to our live streams earlier in December, before this thing really took off. And that was also a call out in our community. We do this report every single day called the call outs and actionable ideas. And tomorrow, actually, for a thank you for all the people who have been watching the channel, tomorrow we are doing a free report for anyone who wants to sign up of our call outs and actionable ideas, which again is mainly just for our partnership circle members. But as a thank you for everyone watching this year, as well as it being Christmas time, we're going to go ahead and send that out to anyone who has their email with us. And so if you guys want to receive that report for free, just go to our website, macro-optics.com, and go ahead and put your name and email into the webpage hero thing here. And you'll also be getting our Monday macro signal. So yeah, that's the free newsletter that we put out every single Monday that covers the different trading ranges for SPY, Qs, and IWM. And so, if you put in your name and email address in there, we'll go ahead and send you the callouts and actual ideas report tomorrow, which typically comes out at around 8 in the morning. So a little bit of a holiday free promo there. But yeah, taking a look at just this week, quiet week, but we're still getting a lot more signals, right? Even though it's low volume. And taking a look at the target rate probabilities for the January meeting, the probabilities of a continued pause from here ramped up to 80% from 78% last week, right? So the odds of them pausing here have shifted almost like from 70-30 all the way to 80-20. So yeah, it's most likely going to be a pause. And then that's pretty much the update for today. There really isn't too much going on here, but I did wanted to, hop on here to answer anyone's questions for the short week, as well as, just showcase my thoughts for inflation, seeing that the leading indicators are actually showing, of a more disinflationary environment heading into 2026, which is good news for the soft landing people. Doesn't really matter for macro investors because we just go wherever the bull markets are. There's always a bull market. Just got to know where to look here. But yeah, pretty little bit of a quicker show today because I do also have to head back to my home office here to see how they're doing with the internet. But yeah, we'll go ahead and open it up for any types of questions here. How's everyone doing? Everyone excited for the holiday week here for Christmas? Then we got that weird week in between Christmas and New Year's where everyone just looks like they're typing emails at work. They're just counting down the hours. Yeah, let's see here. Platinum, one of the main ones that have been, part of the bigger movers, as well as gold miners. So if you take a look at something like GDX, that one too. I mean, that's a pretty good looking chart there with gold miners. Same thing with silver miners, right? Can't go wrong there. Gold continues to perform. Pretty decent move today. New highs, new all-time highs. So there's literally not a better time to take some profits here. So selling a little bit of that. Silver, obviously the way stronger trend between silver and gold. If you just take a look at the ratio between silver and gold, you can see that, silver is having a breakout compared to gold. So that would be the preferred if you had to choose between the two. And by the way, on TradingView, whenever you're trying to decide between two bullish trends, you can always just go into the symbol search and create a ratio to see, which one is having the stronger trend, right? So, like, I don't know, do a couple of other examples here. Let's see, Tesla is in a bullish trend. Trying to see what else would be somewhat comparable. We'll do two sectors, okay? So let's say the two best performing sectors today are industrials and financials. Which one would be, a better one to choose if you were to choose one? Then you can just do XLF and then divide it by XLI. And then just hit enter. And then boom, you have your answer right here. Since XLF financials is in a bullish trend compared to industrials, right? If I would have done the opposite, let's say I started with industrials and then created a ratio with financials. See that? It's in a bearish trend versus financials. So even though both nominally they're both in a bullish trend, financials would be the better pick. And you can do that between any two assets. It's kind of like in fantasy football if you're trying to decide on like who to start. What's interesting is that ever since November, we saw that central bank liquidity actually bottomed, right? And so ever since November, we've had this bounce here in net central bank liquidity, which should be good for things like Bitcoin. And so what's interesting is that if you overlay a price of Bitcoin on this chart here, you can actually see how ever since the rate of change of net central bank liquidity has bottomed, Bitcoin did go down a little bit after that, but ever since then, it's pretty much been stabilized and has, had a somewhat of a local bottom here at around 85,000. Still struggling to bounce on top of that, but in terms of Bitcoin, we are seeing it get incrementally less bad, as well as with we're seeing a positive development with volatility. So really keeping my eye on Bitcoin here to see if it's able to have a recovery, as we see some good signs there. But still in a bearish trend technically, so I'm not buying Bitcoin yet. But I do have my eye on it. And then, dollar remains in bearish trend. Long end bond yields remain in bullish trend. Look at the 30-year compared to the 2-year, right? That's what we talked about before with that bear steepening in the yield curve. And then in terms of like credit risk, I really don't see any signs of credit risk out there, right? Look what spreads have been doing. Still in a bearish trend, right? So not seeing any type of credit risk there. And so for all the fear mongering that's going out there in the markets, it's for the time being, it looks pretty okay heading into next year. So I would fade a lot of the bearish narratives that are out there. But I do I'm curious to hear what you guys say about that. A bit of an abstract question, but do you trust all that government data that came out in December is representing the real case we had from July to September? Cases that were correcting, for example, the unemployment. Well, are you talking about inflation data or are you talking about employment data? Because, we had a government shutdown. So because there was 2 months of no data, obviously that's heavily skewed, right? And so what you have to realize is like the government data that comes out with like the CPI or the jobs numbers, all of them are backward looking. You have to be looking at what those are saying in comparison to the forward looking indicators, which is the price charts, right? So even if we didn't get any type of government data and they were just if it was all like private, like the public couldn't see those numbers, then you could still look at the price charts to see how it's being priced in, right? So only use like the government data as a confirmation of what we're seeing in the price charts, if that makes sense. So remember, you don't invest in the CPI data. You invest in these things that are priced on the charts. So those things matter more. And also as well, looking at volatility, look at this huge vol crush, this is not indicative of getting, bearish in the markets, right? It's a good time to sell some today to take some profits, but yeah, I'm not seeing really any bearish signs right now. All right. Well, we're going to go ahead and wrap it up there, ladies and gentlemen. I got to head back to the office here, but again, we're gonna send out that free report tomorrow morning. So if you guys would like access to those call outs, just head on over to our website here and just throw in your email so that we know where to send it. And then you'll get that there with the list of tickers as well as our full macro release on what we're bullish and bearish on. But I appreciate everyone for joining. Have a great rest of your day, and we will see you in tomorrow's daily macro update. Bye, everyone.